Hey, good afternoon, everyone. It's Eric Foley over at the Supreme Lending First Integrity Team, NMLS 502070. So today I want to share some insights about your credit report, how that determines what you qualify for, and interest rates, and just kind of the big picture. So when you apply for a home loan, what the industry does is that we pull all three of your credit bureaus. So we're going to pull your Equifax, your TransUnion, and Experian. Each one of those is going to have a score if you have established credit. And so, what the industry does is we take the middle of those three scores. They're not always exactly the same. Each bureau has a different statistical model and different things that weight. They're close, but they're not exactly the same, and that's why the industry uses the middle score on pulling three credit bureaus for an applicant. Now, if you only have two credit scores, which is not that uncommon, then we would take the lower of the two versus the middle. And when there's a joint application, so you and someone else, same thing. We're going to take the middle scores of both applicants and use the lower of the two. So sometimes, as a result, it make more sense to only use one of the applicants for the home loan versus both of them. The flip side of that coin is that you can only use the one applicant's credit score, but you can only use their income as well. So sometimes that creates a challenge. One of the other things that we get asked a lot is a soft pull versus a hard pull. So a hard pull is usually for a mortgage loan, an automobile loan, a credit card. A hard pull could have a small impact on your credit score, just a few points. It's the one that actually requires permission. We're going to ask you in writing, electronically, or verbally, can we have your permission to pull credit? Now, a soft pull is usually used for like a background check for employment, or maybe a credit card issuer checks to see if you might be eligible for a credit card, or insurance. It's a little bit different. So when you pull it, there's no effect on your credit score, and it usually does not need permission. So sometimes the scoring is a little bit different, and that kind of leads us into Credit Karma. So people check their Credit Karma all the time. My Credit Karma is at 750. Well, it is on what's known as Vantage 3.0, which is a different statistical model than a hard pull, which is usually using Vantage 4.0, or now there's some newer ones like FICO 10T, and again, the Vantage 4.0, that they're not going to be the same. So, and again, it's one score. So Credit Karma might say you have a 720, but then the other two bureaus are a 600 and a 610. Again, we're going to use that middle score. So we're going to use a 610 to qualify you for a program and for pricing purposes. So there's things that go into your credit, and you can look this up online. But as of today, with a FICO score, 35% of your score is your payment history. 30% of your score are amounts owed. 15% is the length of your credit history, so how long you've had accounts open. Then it rounds out with 10% of your credit mix, which is revolving versus installment. And then 10% of the score is your new credit, how long your most recent credit has been open. So all of that goes into a credit score. Now, the newer models that are going to be taking effect, actually one of those right now, but not everybody's using it yet, is going to look at something else that's called trended data. And that's going to look at how your balances go up and down over a 24-month period. And again, what kind of credit you have, the mix of the credit. It's just going to be a piece of that statistical model that they haven't used before. One of the other changes in it is that on the FICO 10T is all inquiries within a 45-day period are going to count as a single inquiry. So again, that could be beneficial to a lot of consumers. Um, but under this new model, if you just started today and never had credit, it would take 180 days for it to generate a credit score under that new FICO 10T. The current Vantage 4.0 is 30 days. So there's a little bit of a difference in there. Why is your credit important? Yes, there are options if you don't have any credit, where we can underwrite a home loan and qualify you. But there's a difference between not having credit and having bad credit that you just don't want to. Your bureaus generate a score, that score is used. So if you generate no credit score at all, then we can use some of the manual underwriting processes, which are generally okay. You got to be between 29% on your front end for your housing ratio and 41 to 43% on your total back end debt ratio, which includes all of your bills and the new proposed housing payment. And you have to have the rule of thumb is four alternative trade lines with a 12-month history. One of those has to be your rent history, which can be verified. And then the other three have to have been open for 12 months as well. So again, 3 and 1, and you can use a lot of different things in that. Obviously, rental payments, cell phone bills, insurance payments, all kinds of stuff. We can talk about that at a different time, but it's important to know that. And then the other thing that we get asked a lot is, how do I improve my credit score? I don't work for the credit bureaus. I see these are general things. Number one, obviously, is, pay your bills on time that report. All your bills need to be paid on time. Number two, though, is make sure there's no errors in your credit report. If there are, you can get those cleared. It's a process that we'll talk about at a different time. But one way is to also reduce the amount of debt that you owe. Going back to what affects your FICO, 30% is the amount of how much you owe. And what this is, it's your credit utilization. So let's say you have credit cards that have available credit of $10,000. You want to keep that less than $7,000 to have a positive impact on your credit score. When you start going over that 30% window, then your credit scores start going down. So that's important to keep in mind. Another thing is, again, having available credit. So if you pay your credit cards down to zero, keep them open. Don't close them. That is a positive impact on your score. Another thing that you can keep in mind is, don't go out and open a bunch of new credit cards at once or new accounts at once. That generally is not good in the score. And believe it or not, paying off collections, if you have any collections, does not necessarily improve your credit score. So consult your mortgage loan officer if you're thinking about doing that. Another way to help build the credit too is through secured credit cards. So example, not going to name an issuer, but you send them $500, they put it into an account, a savings account, and then they'll issue you a card with a smaller balance, usually like $300. If you go out, use that, charge on it, pay it off or down to very low so that you have a small monthly balance, that has a really good impact on your credit scores. So with that in mind, the things you don't want to do, again, we talked about not paying collections off. The payment history is important. Not opening a lot of new credit. The other thing is, hey, you want a really good piece of advice? Don't be a co-signer for somebody. I can't tell you how many times that comes up. The other person doesn't make the payment, and it affects you because you're a co-signer on that account. Your credit report for a mortgage loan application is good for 120 days. So if you start today, we pull your credit, you take an application. That credit bureau is going to be used for 120 days unless there's been some major changes. And then there's ways for us to go in and actually take a new peek at your credit with a higher score. But for the most part, we're going to keep that for 120 days. And then if you haven't found a house, well, then no big deal. Again, just talk to your mortgage loan officer. We'll go in, get your permission, pull new credit on it. We also use in the industry, at least most of us do, some software that's available through the credit companies that'll model how to improve your score. So if we're talking and you don't qualify, you're right on the edge, I can look at this software, run a couple scenarios, and say, well, if you do this, this, and this, then you're likely to have your scores improve by this much. It's not exact science, but it's pretty darn accurate, and we use it on a daily basis. So I hope this all kind of shares or shows some insights into the things that affect your credit, how to improve it. And again, if I can be of service or you'd like to get pre-qualified, give me a call. Eric Foley, the First Integrity Team at Supreme Lending, NMLS 502070. Have a fantastic day. Thanks.